Marcus Stanley, you're the policy director at Americans for Financial Reform USA. On Saturday, we will be, I'm not sure, commemorating the death of Lehman's 10 years ago in 2008. Have lessons been learnt from the financial crisis?
I think if lessons have been learned, then not enough. We really have not mounted a regulatory response that's as comprehensive or as deep or goes far enough to respond to the problems that were revealed in 2008. In 2008, we saw the worst global financial crisis since the Great Depression. And in response, we've seen reforms that are essentially incrementalist, aren't really deep structural reforms that fundamentally change the system that brought us 2008. And even those incremental reforms are now under attack on both sides of the Atlantic. Even those incremental reforms, which experts, I think, across the academic and political spectrum agree did not really go far enough, even those are under attack and being rolled back.
We can see that Obama made some progress in this area, but what progress has been made appears to be being rolled back on. What implication does that have for Europe and its regulators?
Well, I think one important thing that was true for a number of years after the crisis is that the U.S. was a force kind of pushing Europe to be tougher in terms of its regulation of banks in particular, because the U.S. regulators felt that their banks were stronger and could sort of stand up under stronger regulation, whereas some of the European regulators continued to be afraid of the solvency, continued to be concerned about the solvency of their banks. And the U.S. regulators were actually fearful that if Europe was too weak, then there might be some contagion back from Europe to the U.S. But I think that under the Trump administration, that's really changed, and now we see some of that race to the bottom dynamic kind of reasserting itself, where both the U.S. and the EU regulators may be sort of, in some sense, pushing each other on competitiveness justifications to become weaker. And the U.S. under Trump is not pushing the EU to be stronger in the way that it was previously.
What would you say to those from the banking sector and maybe even regulators who are concerned that if we regulate too much, we'll strangle the sector and we will stop lending to our very valuable real economy?
Frankly, the banks are always going to say that, because every dollar that they can save in loss absorbency, every dollar that they can put on the public sector to bail them out, every dollar that they don't have to use to insure against their own losses, that's a dollar that goes to their stockholders, their capital owners. It's a dollar in additional profit or returns that comes to them. So they are going to relentlessly push for weaker and weaker regulation. And we saw before the financial crisis, they were pushing for weaker regulation in 2008, months before Lehman Brothers failed. So we saw in 2008 and in the years before that there's no limit to the extent to which they will attempt to put their costs and their risks on the public sector, and they will try to do that again today. And just in terms of the growth, the increase in credit and in lending, we're seeing that lending and credit are growing at a faster rate than economic growth. And what that tells us is that financial activity and lending and credit are not the limiting factor. Certainly this is true. I know this is true in the United States. They're not the limiting factor to the economic recovery or economic growth. Things like wages and investment are the limiting factor, and that's really what we've got to be pressing and pushing on now.